Hello, this is Beast McFeast, and we're going to talk about selling options, including the benefits and risks of doing so. I really enjoy selling options in my accounts. It's a good way to generate a little bit of income and can be a high probability of success trade, which is pretty fun. Today, we will go over several things, including why people sell options, selling calls, including the different kinds of calls, selling puts, there's fewer kinds of puts to sell, how to pick a good option to sell, how to exit the trade because you don't want to enter the trade without a plan on how to get out of it. And I will provide an example selling both calls and puts and show you sort of what that looks like using SPY. So there are several reasons why people might want to sell options. The most common reason I run into is people want to collect the premium on it, which is the cost of the options contract. So if you've ever bought an option, you know it costs a little bit of money. Well, that money, a lot of it gets paid to the option seller. This can help you to generate income during more stagnant times in the market. You can also look at it like setting buy or sell limits and getting paid to do that, which is pretty cool. You can use options to create a small hedge against market decline if you're selling calls. And option selling strategies can be done with a high rate of success depending on your strike choice, which is honestly also doable buying options, but people don't think of it that way. And that's kind of a higher level topic that most people just don't believe for whatever reason. Finally, selling options is critical for more complex option strategies, which in reality are not that complex. They just are a little spooky for people. Let's take a look at selling calls first. So selling a call obligates the seller to sell 100 shares of the underlying at the strike price. If this expires in the money or the person who buys it opts to exercise it. When you first sell the call, you will receive a premium which will not be taken away. Whether or not the contract ends in the money, out of the money, or gets exercised early, you keep that premium. At any time, the contract buyer can choose to exercise the contract, buying the shares from you at the strike. Realistically, the only way they're going to do that is if the underlying is trading higher than the strike, or a dividend will push them over that on the ex-dividend date. So that's something you might be cautious of. Be mindful of dividends coming up and possibly making up the difference between where the underlying is trading at and your strike. If the contract were to expire above the strike, which is in the money, your 100 shares would be called away and you would sell them at the strike price. And if you make a profit on that, that's great. You also get to keep the premium. Now, you can choose to sell calls without collateral. And if you do that, be cautious because you have exposed yourself to unlimited risk. For example, if you sell a call with a $10 strike on stock XYZ and XYZ rockets up to $100, well, you're really going to have to go and buy those 100 shares at $100 unless you have them sitting in your account already, which would be really costly because you're going to turn around and sell them for 10 immediately. Many people sell covered calls. I do this a lot. What this means is that you already own the shares that you're selling the call against. So if you have 100 shares of XYZ, you sell a call at whatever strike you want, and if it goes in the money and expires in the money or gets exercised, then your shares will be sold. And you won't owe anything. You'll actually just pocket what strike price is and the premium. The downside to this strategy is it limits your potential upside should the underlying increase in value sharply above the strike. This is sort of like setting a sell limit, which would be the strike price, and getting paid to do it. So if you are 100% certain, for whatever reason, that something you're holding on to will reach a certain price, well, go ahead and check and see if there's a strike at that price, and you can sell a call at that price. And you can continually sell a call at that price, collecting premium until it reaches that strike. You can also sell calls as part of a more complex strategy. For example, the poor man's covered call. You can go ahead and check out my video on that if you'd like to learn how to do this. It's really not that complex. You might also sell near in-the-money calls as a hedge against a small decline in an underlying. So this is pretty similar to what buy-right ETFs do, and it is not really difficult to do on your own. So let's say you're looking at an underlying that's trading at $9.50, and you say, okay, well, I'll buy 100 shares, and I will sell the $10 strike and collect the premium. And you collect, I don't know, a dollar in premium. Well, that gives you essentially a dollar cushion that even if the underlying declines below that price, you're good. And if it goes through the strike, well, you collect the premium, which would be $100 plus the difference between the underlying where you bought it and the strike. So $150 if it were to go in the money. Now let's take a look at this example on the left with SPY. So this is a popularly traded ETF. Probably the most popularly traded ETF. Let's say that I've got a vet bill for my dog, and I've got 100 shares of SPY sitting around, and which is kind of expensive, to be honest. We're talking like $40,000. So whatever, I have $40,000 of SPY sitting around. I need money out of it for my dog, and I don't want to sell the shares. So what am I going to do? Well, I'm going to sell a call, and I can pick one of these strikes over here, and we're looking at a 3-day strike. So this contract is only in effect for 3 days. Then it's gone. If it expires out of the money, I'm going to keep that premium. If it expires in the money, I'll sell my shares for the strike and keep the premium. So what we're looking at is the bid column. Notice it's lower than the ask column. Bidding is what your sell price is essentially at the moment. And I look down here and I think, well, I don't really want these to expire in the money. I'm going to look at the 437.5 strike, which is a 0.35 delta. As a rough rule, that indicates this has a 35% chance of going in the money at expiration. That's a very rough rule. It depends greatly on market conditions. And there's no mathematical way that that's derived, and it's pretty inaccurate, but people use that anyway. So now you know. And for that, I would get $1.91 a share for selling this contract, or $191, which, hey, lucky me, covers my dog's vet bill. I guess I have a discount vet in this scenario. I hadn't really thought of that. Super cheap vet. And I would get that premium, the $191, and whether SPY increases or declines, I'm going to keep that premium regardless. Doesn't matter. It's mine. I can take it out and send my dog to the vet. Now let's take a look at selling puts. So selling a put obligates you to buy 100 shares of an underlying at the strike, even if the underlying is below the strike, which is why people buy puts. So you don't have to have the underlying in your account to trade this, or anything as collateral except for maybe money to back it up or margin to back it up. So you'll receive a premium for this regardless of if it expires in the money or out of the money. Some people will use this like a buy limit that they get paid for. So if I say stock XYZ and that thing's only worth $6 and it's trading at $8, well, I'll go ahead and sell the $6 strike put and get paid a premium for waiting, which is not bad. Now the different types of puts. You could sell a naked put, which obligates you to buy shares that you can't afford, which is obviously a risky scenario. I might not do that, but you can. You can also do a cash secured put, where you have cash on hand to buy the shares at the strike. It's very safe. And then you can sell puts that are secured by your margin limit, which would put you at risk of a margin call if the market sharply declines. Now, one risk of selling a put is that you might be buying these shares for much more than the market value, which is very unfortunate. And you want to make sure that that doesn't happen. So go ahead and watch these pretty closely. And if it starts going the wrong way, you can bail out of the trade or roll down the strikes. And we'll go over that in a minute. But first, we have an example. I have a Shih Tzu here. He's a much more expensive dog. So we're going to sell a put at the 431 strike, also on SPY, for 3 days. And again, we're on the bid column because it's the sell price of these things. That's what we're selling them for. And the ask is what people are buying them for. And when these two meet, the trade is made and the market maker takes a cut, essentially. So we go down here and we're going to select the 431 strike on the 3-day call. And that would provide us $261 in premium, which sounds okay, except for we're going to tie up $43,000 in buying power, unless we use margin or do a cost limiting strategy such as a spread. So this just gives you an idea of how to do it. This one's not the best, honestly. It's just one you could do. So let's look into how to select, better choices. When you're looking to sell options, you want an underlying that meets some basic criteria. You really want to select an underlying that you like or that you would like to sell. Because if you're selling a put, there's a chance you get assigned where you'd have to buy it. And if you're selling a call, of course, you'd have to sell it. Now, you really want to make sure that you're okay with taking assignment on these because it will happen if you sell enough options. And don't get emotionally attached to them. Really don't. People do that. Don't do it. You want your underlying to have pretty high implied volatility, or your premium received for it will be very low, which no one wants a low premium because you're taking on the same amount of risk for less money. It is preferable to sell highly liquid underlyings with many strikes if possible. That way you're not shoehorned into selling a strike that you're not thrilled with. And on the subject of having many strikes, weekly strikes are pretty nice if you can find an underlying with it that you don't mind trading, because the weekly cost of options is very high, much higher than the monthly cost. I mean, I did an example on another video where I was selling a SPY call, and the 3-day made $300 and the 30-day made $800. You could just sell multiple 3 days in the same period of time and come out very far ahead. So the power of short strikes shouldn't be ignored, or short-dated strikes. Finally, ensure that you can meet the obligation that you are making. Don't engage in naked trading that you can't cover. Let's talk about exiting the trade. You want to bail ship on this for some reason. Maybe it's not going your way, or it's going your way and you're ready to take profit. That's fine too. The things you can do. You can wait for the contract to expire. If it is out of the money, you will keep your premium and do not have to fulfill your obligation. You can sell the same option again at a different expiration or strike if you want. That's if it ends out of the money and stays out of the money. If it expires in the money, you will have to fulfill your obligation as outlined in the contract. So if it's a put, you're going to be buying 100 shares. If it's a call, you're selling 100 shares. You could buy the contract back prior to expiration, and this is known as buying to close, abbreviated BTC. Ideally, you would buy the contract back for far less than you sold it for. But if the trade goes against you, you might have to buy it back for more. You'd really only do that if you don't want to fulfill your obligation on the contract. You can roll the trade, which is buying the contract back and immediately selling a new one. So let's say you have 1 day left on a contract and it's way out of the money, and you say, well, I'll just buy it back for $1 and use this opportunity to sell another one and pocket that premium. Well, that's perfectly fine. That's how you roll a trade. Some brokers and trading platforms have easy options to do that. Like you can just select roll as an option or quick roll, depending on your broker. Finally, don't expose yourself to pin risk unless you really want that option exercised. Pin risk is when the underlying is trading very near the strike of your option. So what will happen is you'll come around to expiration date and the market can close, and then an after-hour move can put your option from out of the money to in the money. That's why a lot of people would recommend buying back those $1 options that are out of the money, or very inexpensive options out of the money, just prior to market close. It might sound like a small risk or remote risk, but it will happen eventually if you trade enough. And it's an expensive mistake to make. If you have found this video useful, please go ahead and hit that like button or upvote or let me know in the comments. Thank you for watching. Please leave any questions or ticker recommendations in the comments. Good luck. Get rich. Bye.